Hi, my name is Jordan Wilson. In our last session, we sort of looked at the pros and cons of actively investing or giving your money to someone to actively manage on your behalf. And I think most of the evidence, it's back and forth a bit, but I think if we looked at that last slide, we saw that it is difficult for a variety of reasons. Fees, hard to pick consistently winners and losers over time, trading costs, the more complex strategies. It's very tough to actively manage and beat your benchmark return on a net basis, and that was the concept of alpha that we talked about. So difficult to outperform your market benchmark through active investing, even for the professionals. So the question is, should you actively invest at all? Now the answer is probably not. And I'll put a caveat in there. At times, perhaps maybe I'm a little hypocritical myself. I would seldom recommend for especially smaller clients, individual assets. But I like to assess stocks and do analysis myself. So even though I tend to prefer, even personally, ETFs and index funds, I do like to trade individual stocks on occasion. But when, if ever, does active management make sense for an individual? And today we're going to look at two different areas, really. We're going to look at markets, inefficient, ignored, or long-term phases of markets. And we're going to look at what I call niches, niche markets, niche sectors, areas of expertise that an individual investor may have. And as we saw in the last session, there are at times and in certain segments some evidence of prolonged or consistent manager alpha. We'll wrap up by just looking at a real world example and why there's some issues for active managers. So first of all, the markets. There may be opportunities for active investors depending on the type of market. My first point is inefficient markets. And that's more a technical finance term from efficient market hypothesis. And in general, what you find is that passive investors believe markets are highly efficient. And by efficiency, that's where a security's price reflects all relevant information. Now, if that's true, then it's not possible to use active management techniques, such as security analysis and selection, market timing, to beat the markets. As a result, the passive investor simply invests in the market itself, usually through index funds. Now, the reality is that not all markets are highly efficient. And I'm not sure even the passive investors would disagree with that statement. We'll look at niche markets on the next slide. But if we look at developing countries, that's an area where there's often inefficiencies. Some of these developing countries may not have stringent insider trading regulations. Some may not have comprehensive and transparent reporting requirements. Some countries are just more corrupt than others. So if you have a market in a region or nation that doesn't have proper rules, proper regulatory governance, like the securities commissions in many countries, then certain individuals may come into corporate information that other investors do not receive. It's no longer that level playing field where everyone has access to the same information. In this case, there's certain individuals that have extra information, and that can give them an investing advantage. So, developing nations, less efficient, more opportunity if you're the one that has access to the specialized information or the inside information. OTC, over-the-counter type markets. That's another area which tend to be relatively inefficient. Shares that trade OTC tend to have less consistently public available information for investors to assess. And adding to this is the fact that many OTC companies have a relatively limited corporate history. And that's not true in all the cases. There are some long-standing OTC companies, but it's on average maybe less of a history and less market capitalization and less trading on a daily basis. So it's hard to sort of discern patterns or trends when you have wide bid asks and not a lot of trading on a daily basis. So that's an area, if you have access to better information in an inefficient market, then you, as an active investor, can prosper. The second point I'd make here is that some markets are ignored. And we can see that there's the connection with inefficient markets. If I'm an active investor, even if I run a mutual fund, I want a level playing field. I don't want to be competing with somebody in an inefficient market that might have access to better information, thereby allowing them to make better and more timely investing decisions than me. So some active managers intentionally avoid inefficient markets and stick to places where that they do have that level playing field or that perceived level playing field. Even in developed nations like North America, you have market segments that may not be extensively covered by analysts. And there's a variety of reasons why that's the case. Now, analysts and investors tend to do an excellent job monitoring large cap stocks. You have a ton of analysts studying, say, Coca-Cola, Amazon, Google, Facebook. You probably don't have a lot of analysts, and sometimes you may not even have one, monitoring the mom and pop factory that's making consumer goods in Los Angeles, California, or the one I always talk about, the mom and pop size mining company in Western Canada. So it's just sort of too small, and what you see is the nano or the micro cap stocks are often on a relative basis ignored by analysts. And if you recall our discussion, microcap, often say 50 to 300 million US in size for market capitalization. Nano is probably less than 50 million. So quite small. And even when we looked at our RBC Canadian Equity Mutual Fund example over the last few sessions, that's at $2 billion in assets. You don't get much bang for the buck in your portfolio studying intently to find investments that the entire market capitalization of the company is under $50 million. So again, there's that cost of investing or tracking things, and you just don't get the return on an overall portfolio basis by investing in smaller companies often. Another area that I want to discuss, which differs in different jurisdictions, but let's look at the US, for example. The 75-5-10 Diversification Rule. And that comes out of the Investment Company Act of 1940 in the States. So 75% of a mutual fund's assets must be invested in other issuers' securities, such that no more than 5% of a fund's assets may be invested in any one company. So you want to keep basically no more than investing 5% of your fund's assets under instrument in most companies. So that's sort of a 5% threshold on many of the investments. The 10% comes in where the fund may own no more than 10% of a investment's outstanding stocks, for example. So you don't want to invest in more than 10% of a company's market capitalization, just to keep this on a general basis and not get into different share classes and whatnot. So that's good to know. And that plays a part in what companies can invest in. And we discussed the logistical reasons already with a RBC $2 billion equity fund, just looking and trying to find investments that have a material impact on their portfolio if they're only, 50 or $100 million in size. And then you compound that by, I can only own 10% of that company if it's in the US. The final point I'll make on markets is long-term phases. Now, market timing is exceptionally difficult. And that's a large reason why, along with costs, that it's hard for active managers to outperform. So getting the timing right is hard. But it's slightly easier in long-term phases, but not always. And when I talk about the long-term or the intermediate phase, let's say, so it's very hard to tell, has the market bottomed out? So when is the recession ended and the cycle is going into a bull market? Or when is the end of the bull market and the start of the recession? And that's where it's really, really difficult for investors to assess, with close proximity when the actual market is going to turn. But if you end up in a bull market for 5 years or a bear market for 3 years, you may be able to, if you can identify that it's prolonged, adjust your portfolio. Bear market, we talked the other day about moving into defensive or even value stocks. If interest rate regimes are on the rise and you're confident that it will continue, you want to shorten durations. Now in Canada and the US, over the last, I guess we're coming up almost to a decade now, every year the drumbeat is that interest rates will rise, interest rates will rise. And so you have a lot of active managers who reduce their portfolios in fixed income, durations that is. And then we didn't see that happen. And they should have been better off if they'd stuck on the long end of the curve. So not easy. And then the costs involved also make it tricky. So the more that you trade, there's hard costs. And the opportunity cost, which turns into a real cost in this case, of getting the timing wrong. So if I think interest rates are going to rise, I shorten all my durations on my bonds, and presumably that will be into lower interest rate yields. If rates don't rise, I've lost yield return. Similarly, if I think the equity markets are going to go on a recession and I shift all my assets into defensive stocks and that turn doesn't happen, I would have been better off maintaining my existing portfolio. So there is that possibility, but just beware, it's not always the easiest thing to do. Now we talk about niches. And the first thing I want to talk about with niches is just the markets in general. And I mentioned this before with the less developed nations. When you get down to a niche, you probably have fewer knowledgeable analysts and even fewer knowledgeable investors. And a lot of that is the lack of the information, the lack of the history of the company, the lack of competition. So you get less information. You also, because they're smaller companies or more in certain pockets or sectors, you just in general have less people covering them than Amazon or the S&P 500 stocks. So often less efficient is due to the fact there's less focus from the investment professionals. And so if you have expertise, experience, insight into these markets, that gives you an edge, and there's more chance of finding buried treasure. And I have these listed here as niches. Fine art. When I was with UBS, I used to know a couple of people that ran the fine art department. They were expert in their fields. They could look at a painting and decide this is a fake, this isn't a fake, on a relative basis against other paintings, this is what it's worth, all this stuff. I have no clue. Collectibles. That might be coin collecting, numismatics, stamp collecting. Gems. An old friend of mine used to collect emeralds and diamonds and rubies, and he became quite good at assessing quality. I would see these, and it's just a beautiful red rock. Wine has become popular as an investment in recent times. So if you have a expertise and that's your area of training, then you can explore these markets. And I carry that further into sort of, again, the sub areas or the more generic areas. So it's not a niche as in we're investing in the fine art sector or the numismatic sector or even the Polish real estate sector. This is more expertise in common market segments. You're a geologist or a geophysicist or a petroleum engineer based in Saskatchewan. Maybe that gives you some insights and expertise into Saskatchewan junior mining or oil and gas companies. And if they're not being targeted by the analysts, you're in an advantage against other investors because you have some know-how. I once had a client when I was in public accounting that bred cattle. Basically, it was a bull semen farm. So again, they have expertise in that field that most of us have no clue about. And the final one here that I list is intuitive surgical. And a friend of mine in the US is in the medical industry. And in the early 2000s, mid 2000s, was dealing a lot with Da Vinci systems, sort of medical systems and a variety of things. And the owner of Da Vinci systems is Intuitive. So he ended up buying, he said, oh, this is a very good product. This really helps my area of expertise. He was a surgeon, and this is a great company. And he bought shares at roughly $35 a share. Today, Intuitive is worth about $800 US per share. And by today, we're talking kind of mid-February 2021. So I used to joke with him that he almost made more money from just investing in Intuitive than from his career as a surgeon. And he's probably not far off if he, in which made him more money over time. But he identified a system, Da Vinci, that was at the time groundbreaking, got in, not quite on the ground floor, but early enough, and prospered. And again, you or I, if we're not working with those systems, have no idea until we read about it in the paper and it's already in the 100 or 200 or 300 range. So area of expertise. The final niche point I want to point out is manager alpha. And we saw this in our last session. There are some areas and some times that managers seem to be able to consistently outperform certain markets. We saw some of the bond markets, sometimes in bear markets, active outperform passive. We saw some of the international equities, especially in the smaller sectors. So at times you can see manager alpha, but again, foreign smaller cap equities, that kind of gets us more into the niche or the market sector that's either ignored by some analysts, or where if you have people on the ground that know what's going on in Warsaw, Poland, or Bogota, Colombia, maybe that gives you an advantage. And in the old days, you had guys like Mark Mobius from Franklin Templeton running around the globe, hiking through the jungles looking for investment opportunities. And the times have changed, but again, on some level, having boots on the ground can provide an advantage for fund managers. Last thing I just want to quickly go through sort of a real world example just to kind of tie everything together. So I've got three companies here in a mutual fund. The first company is Dragon Capital. It's an OTC stock, and it's Vietnam's longest running independent asset manager. It's trading at 0.25 pennies, so very, very small. Its 5-year range has sort of been 0.1 cent to where it is today. So it's truly not even a penny stock. Its market cap is currently 5.1 million US. If we look at that 10% rule from the SEC, a fund can only invest a maximum of $500,000 in that. If I'm RBC Canadian Equity and I'm worth $2 billion, that's not even worth my time. And again, if you look at some of the larger US funds, $2 billion is actually not that large. Kinger Pay Corporation. They're a digital payment solutions company based in Indonesia. Their current price in US dollars is literally a penny, 1.2 cents. 5-year range, they were starting out at 0.7, so that's not too bad, but they've fallen to where they are today. But during that 5 years, you've seen some spikes up to like 2.37. So again, if you knew Kinger over this 5-year period, where they're trading at a penny today. And at one point they were $2.37. If you were on the right side of those trades, you'd be a millionaire in trading that. Now, the fact that their market cap is so small, I'm assuming the bid-ask spreads on trading would be phenomenal as well. But again, just on a price basis, a lot of opportunity. Again, with a market cap there of 18 million, if I'm a mutual fund, the most I can buy is $1 million, $1.8 million, not a lot. Grow Solutions, a Saskatchewan-based cannabis provider of products and services on an international market. They're at hard times right now by the share price, 0.55 cents. And their 5-year range, closer to the 5-year point, was $1.10, all the way down to where it is today. So again, if you were on the right side of the trades and your bid ask was small enough that you could buy or sell at those prices, you could have made a pretty penny. And who knows, maybe it'll go back to $1.10 in the next year or two. Its market cap is only 12 million right now. So again, if I'm a fund, I can max out at just over $1 million in the investment. Would that interest RBC Canadian Equity Fund? Not at all. $2 billion, 1 million divided by 2 billion? That's a drop in the bucket. That has no impact on the overall portfolio performance. So even though Grow Solutions is indeed a Canadian equity, RBC fund presumably would never even look at it. And then the last one I have here is just Fidelity, International Small Cap Equity Fund. Now by small cap, nano and micro, like these ones, are probably too small for the fund to consider anyways. But this is a $2.6 billion fund. At even 1%, not 10%, that's 26 million to invest. And as we see in the above, 500,000, 1.8 million, 1.2 million. On a percentage basis for Fidelity, even if they could invest in those companies, it makes no sense. Again, no impact on the bottom line for the fund because the companies are too small. Not to mention, at those market capitalizations, even if you could buy 25% of the companies, how many of the dragon capitals of the world would I need to fit in my portfolio of $2.6 billion? What's the management time, the accounting time? Oh, just drive you crazy, and add up the fees that go out to the investors. So that's sort of a real world example. And again, all those figures are sort of February 12, 2021. And no doubt by the time you listen to this and look them up, they'll have changed substantially as well. And down the road, I think we'll get into a conversation on bid-ask spreads. But part of that was liquidity, where just because a stock trades at $1.10, that might have only been 1,000 shares. So if I want 10,000 shares, the ask might have gone up. So in fact, in this case with Grow Solutions, you might argue, or actually let's say Kinger, where it goes to 237, is I might be looking to fill 10,000 shares. But if there's only 1,000 on offer at 70 cents, then when you get into the behind the scenes, the bid and the asks, then there's going to be substantial fluctuation. The greater the demand, the higher the ask is going to be. So I think we'll talk about that in a little bit as well. That's it. Active investing. Is it right for you? Probably not. But as we just went through, if you have some expertise or you have inside information in a less developed market, sector, or country, maybe there is an opportunity. So don't discount active investing, but look at where you bring an advantage to the table. That's all for today. Thank you very much for your time. Have a good day.